Chris Kemp-Pitsis joins us here. He's a managing partner, Barnum Financial Group. Chris, investors had a really good 3-year run in equities. They made a lot of money in the bond market in 2025. What's the conversations you're having with your clients as to expectations for 26?
Yeah, that's a great question. And expectations, I think, as we look to go forward into the new year, the reality is if we look at how the last time we had 4 double-digit up years in a row, that didn't end so well, right? That ended with the dot-com bubble burst. And so if we're going to see another double-digit, high momentum, high growth kind of year, we're going to need some kind of Goldilocks economic and stock performance in order to do that. So what has to happen for that to be the case? Well, first, we need to see those accommodative interest rate cuts from the Fed. 2, unemployment obviously can't get too out of control. And third, we can't have any AI bubble burst. And that means we need technology companies to really show and prove when earnings season comes along. The market didn't react too positively to the last couple earnings seasons, even though these big tech companies delivered great results. And so that leaves us a little cautious headed into the new year.
So if you're cautious, and you talked about tech, Chris, if you're widening out, I see in your note, you like utilities, which makes a lot of sense because in an environment of lower rates, but also all the electricity, all the data centers, right, that are being built to support AI.
Exactly right. So we think of that as almost an AI adjacent play, if you will. What are the sectors, what are the industries, what are the companies that are going to benefit from artificial intelligence, but aren't necessarily the semiconductor companies themselves? And thematically, if we can see real companies start to increase their profit margins and their earnings as a result of actually implementing artificial intelligence into their businesses, well, that's going to change the conversation from is this a bubble to how high can we go, in a positive and healthy manner.
Chris, talk to us about how you think about investing in the U.S. versus non-U.S. and maybe that's developing markets, emerging markets. How do you think about that? So,
if you look at the typical investors, U.S.-based investors portfolio, it's extremely S&P 500 centric. S&P 500 almost has a monopoly on the average investor's portfolio. And 2025 was a year in which the international markets, waved their hands and said, hey, take a look at me because we're here too. And meanwhile, you have governments who are evaluating their trading partners, right? We saw that with Liberation Day and the tariffs and the tariff negotiations that have taken place since then. So as countries are looking to really reestablish their trading relationships, and then companies are looking to similarly diversify their supply chains, and then on top of that, you have this weakening dollar, it begs investors to start to take a look at other economies and other markets as complements to their U.S. portfolio.
I'm curious where you're looking in the world. I mean, I know we say Europe, we say emerging markets, but when you sort of drill down.
Sure. So one country that we find very attractive right now is Japan. In general, companies in Japan have very cash-rich balance sheets. There's been a renewed focus in Japan about delivering shareholder value. You're seeing a big increase in buybacks. You're seeing a big increase in dividend hikes. And then you have a much more accommodative fiscal policy the last couple of years. And what's interesting about Japan is, the knock on them for a long time has been an aging population, but an aging population also lends itself to automation and technology enhancements. So we think it's a perfect opportunity for Japanese equities. And then, of course, with the strengthening yen, weakening dollar, for U.S. dollar-based returns, that's a real positive for the U.S. consumer and investor.
We haven't talked about Japan for 30 years, but it's back in vogue here. I mean, is this something that's a longer-term trend? And my son's about to do a semester abroad in Japan, and he's all in on Japan. But I'm like, all right, that was in 1980. That would have been a good call. But maybe it's coming back here. I don't know.
I think it is because ultimately, we have the volatility of what's happening with AI and a little bit of political uncertainty in the U.S. and, of course, conflict and tensions with China. people are looking for a consistent story, and Japan looks to deliver that here. And they've got a lot of the characteristics of what could present a big opportunity that started in 25, and I think the momentum will continue into 2026.
Just crossing the tape here on the Bloomberg Terminal Red headline, SoftBank to buy Digital Bridge for $16 per share in cash. So there you go.
Speaking of
Merger
Japan.
Monday, baby.
Yeah, exactly. Even on a holiday week.
Yes.
Back to the U.S. for a minute, Chris, and we ticked some boxes, talking about utilities, talking about tech. What about consumer staples? What's the outlook, the prognosis for them in 2026?
I love that question, because what happens is technology has been driving the market, both in the short term and long term. I think most people would agree AI has a tremendous long-term thesis, right? But as we see these valuations reach these highs, we want to start to look to take some profits off of the table. And then the question becomes, where am I putting that portion of my portfolio if I'm trimming slightly from my technology and my growth story? And so consumer staples provides a tremendous contrarian almost allocation, one that is inflation friendly, one that provides a consistent dividend in a lowering interest rate environment that in essence pays us to wait. And we saw this in April, right? When the tariff craziness took place and the market reacted, S&P was negative 15% for the year at one point. Sectors like consumer staples really were a bright spot in a stormy stock market. And I think consumer staples will perform exceptionally well going into the new year, should we see the pullback in technology.
What are you doing, Chris, in the bond market here? We had some nice high single-digit returns in 2025. And if you took some credit risk, doing pretty well rewarded there. How about in 26?
If I'm going to take on risk, I'd prefer to get that risk through dividends rather through yield at the moment, especially because the biggest risk to 2026 is stock market volatility and a worsening economy, right? Those are the traditional concerns around what could the end of a bull market be as we potentially go into theoretically a recession, right? So I don't want to own the types of bonds that are going to act like stocks if the stock market's going down. So if I'm going to own bonds, I want quality. I want a little bit of a duration in a lowering interest rate environment. So I would favor, obviously, sovereign debt, and I would favor cash and dividend stocks.
Very good. Chris, thanks so much. Appreciate it. Chris Kampitzis. He's a managing partner for Barnum Financial Group, giving us some thoughts here on these markets. And